Hello, everybody. Welcome to the webinar. Please post your questions in the Q&A only. We will not be able to respond to questions in the chat box. A recording of this webinar and slides will be posted shortly after today in our community site that you can find at realtime.inc.com. And later in the day, we will also be emailing a copy of the webinar and the recording to participants. Please feel free to share it around. Just briefly about myself, I am the founder and CEO of MultiFunding. I write a regular Inc. column. I have advised former administrations about the business credit markets. I have a book out called The Growth Dilemma. And for my EO friends out there, I'm an EO board member of EO Philadelphia. But you're not here to learn about me, you're here to learn about the CARES Act and how it can help you. Some disclaimers are important. We are in unprecedented times in history and the information available to us is changing rapidly. Please refer to our most current presentation for education. Information we provided as early as yesterday could be outdated. The information we've provided is based upon our best judgment about what we know at this time and a decade of experience with SBA lending. However, key questions remain about how to implement many of these programs. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. Now let's begin. I really want to focus today on the Main Street Lending Program and how many of you could take advantage of it. Just a quick PPP update. As of this morning, the PPP is out of cash. I expect within hours or days, Congress will allocate more money for the program. They will have no choice but to. But in the meantime, many people have not received a formal approval from the SBA yet. If you are in that case, I do not recommend you pepper your application with your personal information around the web. I do recommend that you find a local bank or credit union in your community who is good at these loans. And if your PPP application hits the SBA twice, the worst that will happen is that the second application will get rejected. It is okay to put in, especially if you're in with a big bank or an unscrupulous fintech, it is okay to find a local credit union or small community bank to take your application. Those asking about the EIDL is like the lottery. As of last count, there have been over $400 billion of requests for $10 billion of money, and there has been no talk about increasing the allocation for this program. So if you get some money in your bank account, that's great luck, but I certainly would not recommend that anyone counts on this as part of their strategy at this time. And now I want to dig into the third part of the the CARES Act, which is called the Main Street Lending Program. This program has for $600 billion in loans. There are two different lending facilities. One is for new loans and one is for expanded loans. Businesses can obtain financing from one of these two, but not from both. To participate, you must have as many as 10,000 employees or as much as $2.5 billion in 2019 revenues. So really big companies can take advantage of this. Small businesses, including those that participate in the PPP, are also able to seek loans from this program. The minimum loan size is $1 million. This program is designed for companies that were doing well in 2019. If you did not have good, strong, positive EBITDA in 2019, you cannot qualify for this program. And the program is still open for comments and final details could change. This is early days, but we expect that money will start flowing for this program in mid-May. So today I want to talk about the new loan facility, the expanded loan facility, show some comparative examples and talk about how MultiFunding can help. So let's start with the new loan facility. Eligible lenders for the Main Street Lending Program are U.S. insured depository institutions, U.S. bank holding companies, or U.S. savings and loan holding companies. This is, as we mentioned, for businesses with up to 10,000 employees or up to $2.5 billion in 2019 annual revenues. The business must be created and organized in the United States and have most of its employees based in the United States and significant operations here. And businesses that participate in this facility cannot participate in the primary market corporate credit facility. These are unsecured loans. They are a 4-year maturity. The amortization of principal and interest is deferred for 1 year. It is an adjustable rate of SOFR, which is the bank's cost of borrowing money, plus 250 to 400 basis points based on your credit or credit risk. So SOFR is almost nothing today, 0.08. So essentially these loans will be 250 to 400 basis points, or 2.5% to 4%. And there will be a minimum loan size of $1 million. I'll explain in a minute how the minimum loan size is calculated. There's prepayment penalty without penalty, and there's an origination fee of 1%. So let's go to some examples. Let's say a company, and I'm going to use row 2 here, had $500,000 of EBITDA. The maximum loan they could qualify for is 4 times that, or the not to exceed amount, which is $2 million. However, in this case, the company has $1 million of existing debt, which gets deducted from the maximum amount. So the potential new money they could get is $1 million. In the second example, let's again take row 2. This is a company with $1 million of EBITDA in 2019. So the maximum that they could get is $4 million. Their existing debt is $2 million. So they would be eligible for a new loan of $2 million. In this case, let's take the first example. This is a company of $2 million of EBITDA. So the maximum loan they could get is $8 million. Their existing debt is $2 million. So their potential new money is $6 million. In a very simple scenario, if a company with $250,000 of EBITDA and 0 debt could borrow $1 million. How does this money work? You commit to refrain from using the proceeds of the loan to repay other loan balances. This is not designed to help you refinance other debt. You commit to repaying other debt of lower equal priority, except for mandatory principal payments, until you've paid this loan in full. And you will not seek to cancel or reduce any of your outstanding lines of credit with the lender or any other lender. This is designed to be new money, not old money. This is related, and you can apply based on the financial circumstances due to COVID-19. You will make reasonable efforts to maintain your payroll and retain your employees during the term of the loan. And you will follow the compensation, stock repurchase, and capital distribution restrictions that apply to the direct loan programs and to the CARES Act. You cannot take this money and then pay yourself a lot of it. Now let's talk about the expanded loan facility. What is really different here is the amount that you can borrow, and these loans go up to $150 million instead of the 25 million cap on the new ones. And we'll show that by some examples. And because this is tied to an existing lender, any collateral that will be secured in an eligible loan will be attached to it. And you cannot use this loan to repay old or previous debts. Let's take an example of a company that has, in row 2, $2 million of EBITDA. In this calculation, you multiple times 6 times your EBITDA to get $12 million, not to exceed. But this company has existing debt for $4 million. So you take 30% of their existing debt, and their add-on tranche could be $1.2 million. In another example, if the EBITDA in the third one is the EBITDA is $4 million, and their not to exceed could be $24 million. This $4 million EBITDA company has $12 million worth of debt, and so their potential amount they could borrow is 30% of that, or $3.6 million. In this case, I'll take the first example, a company with $8 million of EBITDA. Their amount they could borrow would be up to $48 million, but there's a cap on it of 30% of existing debt. So the existing debt is $8 million, and the potential new amount is $2.4 million. So which one do you choose? In some cases, you are more eligible for one than another. Let's take the first example. If You have a $2 million EBITDA company with $2 million of existing debt. If you take the new facility, they would be eligible for $6 million under that program. And if you take an existing facility, they would only be eligible for $600,000, which is too small of a loan amount. One real example is a company with $1.2 million of EBITDA. They have no debt historically, but have recently taken on an $800,000 PPP. They can apply for a $4 million Main Street lending program. MultiFunding will have resources available to help with these programs as final details will emerge in the next few weeks, but we have packages to get you ready, get you prepared, and stay on top of it. And if you're interested in that, you can reach Megan Burns on our team. And now we're going to open up the floor for questions, and the moderator is going to take them. We're going to start purely from the Q&A.
Ami, when can we apply for this?
We expect applications to start being taken in the next 2 to 3 weeks.
Are personal guarantees required under the MSLP?
No.
If you are a fiscal year company, for example, 7/31 full FYE, is the MSLP based upon your July 31, 2019 federal tax return?
So that will become clearer in the guidance. So we don't know the answer for sure yet, but I think that's a safe assumption.
How will banks make money on these programs, and are they motivated to make these loans?
I think they are motivated because they're going to make the 2.5% to 4% spread plus the 1%. And they're going to be selling 95% of the paper right back to the Federal Reserve. So they actually have very little risk on these loans.
Any updates on the forbearance guidelines specifically? Is there a spreadsheet available that has which of their four?
Was that forgiveness or forbearance, Hannah? I'm sorry.
It's forbearance, but it might be forgiveness.
Yeah, I'm going to ask whoever put that question in to clarify what they mean.
Concerning the loan defer for Main Street loan, does interest accrue for the year or is it waived?
It accrues. It's not waived. And remember, this is not a line of credit. This is an infusion in your bank account. So once you get it, you have to take it. You can prepay at any time without any penalty, but you are accruing interest from the minute you take the money.
How is debt defined? Is it long-term debt or all liabilities?
All liabilities, including unused lines of credit. So if you have a line of credit, say of $1 million that is untapped, that amount is included.
Since you're required to commit not to reduce existing lines of credit, does that also imply that you need to draw from those sources first before applying to the lending program? Or is it simply as just keeping the line of credit open, even if it's undrawn?
Keeping it open, and that's why this program could be particularly attractive. So let's say you keep the line of credit open and you take one of these and you need some cash to help with working capital or whatever it might be over the next few months or year. I would suggest that it's safer to take it from the Main Street lending program, where it is essentially unsecured money without a personal guarantee, whereas the line of credit may well have a personal guarantee.
If you have less than 100 employees, are you eligible?
Yeah, number of employees has no bearing on it. It's all driven by EBITDA and your debt.
We spent a significant portion of our EBITDA for product development, causing EBITDA to be negative in 2019. If we use the product development as an adjustment to EBITDA, our adjusted EBITDA becomes positive. How will this be looked at by lenders?
That would be up to negotiation and final guidance. So will lenders consider one-time events in the EBITDA guidance? It's very possible, but that would have to be, subject to working it through and further interpretation.
Does debt include credit cards or availability on a credit card?
So I think it will, but just with being respectful to the program and not being disrespectful to people who use credit cards for their businesses, because I do. But that's not really, if you're thinking about that, this program is probably, you're probably too small for this program.
Do we include money owed to suppliers in the debt calculation for this loan program?
That should be payable and not a debt. As long as, there'll probably be some guidance, so as long as that money is within a 90-day window, it's probably a payable and not a debt.
We have a clarification question. Doesn't the Main Street program require fewer than 10,000 employees to be eligible?
It does. I'm not sure if that was confusing. I apologize, but that's the case.
What is the minimum loan amount for the Main Street lending program?
$1 million.
Is your mortgage counted 100% as debt?
I believe that is the case. Now, if the mortgage is held in a separate holding company, how affiliated companies will count is not clear, but I believe it is the case.
Do liabilities include outstanding AP to vendors?
I believe as long as that AP is within the 90-day window, it will not be included.
What about if we don't have our 2019 corporate income tax?
There's going to have to be some provision for that in the guidance because most people don't. Again, I would recommend if you're close to having that done, get it done because it makes any loan application stronger. But I believe at a minimum, they'll accept reviewed or compiled accounting statements from your accountant. And if you don't have that, in some cases, they might even consider internally prepared, but a lot of that will be subject to guidance.
Would we still be eligible if our parent company is in the UK?
That's not clear. It really depends upon if your parent company, but is your company that you own formed in the United States, have the majority of its employees in the United States and filed US tax returns, then there's a good chance. Ownership doesn't, it's unclear.
How open will adjusted EBITDA likely be calculated? For example, our adjusted EBITDA includes non-recurring reorganization costs.
Yeah, so again, that's subject to guidance, but I'm hopeful they'll be fairly lenient about it in the hope of getting the money out on the street. But that may well be bank by bank's decision versus the Federal Reserve's decision. So different banks might interpret that differently.
John is wondering, what is the rate and term on the loan?
The rate will be between 2.5% and 4%, depending on how the bank assesses your credit risk, plus a very small amount that will be variable for the bank's cost of funds. And the term is 4 years. Again, that is by current guidance. It could change a little bit. We saw that with the PPP. PPP started at 4%, then they went to 0.5%, and then they finalized at 1%. These are the current rates as advertised.
Do you know if the 10,000 employee count would include temporary staff for the staffing industry companies?
I don't.
Any restrictions around ownership, for example, PE ownership?
None that we're aware of.
So interest is fixed for 4 years or floating?
The 2.5% to 4% is fixed. The rate can float a little bit based on how the bank's cost of funds adjusts, but we don't expect that to go up in any meaningful fashion anytime soon. Right now, it's 0.08, so technically, the highest you could pay for one of these loans right now is 4.08%.
Is it permissible to purchase real estate with these loan proceeds if the real estate purchase is used to expand?
So there's nothing in the guidance as the term sheets of yet that says what you can't use the money for, except that you can't use it to refinance existing debt or pay off existing debt. So my thinking is that it will be permissible. However, buying a real estate on a 4-year note, unless your plan is to refinance that pretty quickly, it can be quite a scary proposition.
If we really want 400K, could we take the 1 million and immediately pay back 600K?
I don't see why you couldn't, as long as you were eligible for the 1 million. But you're going to pay a full point on the 1 million.
I have heard there are company minimum size limitation. In other words, the program is not designed for businesses that would be SBA eligible. Any truth to that?
Nothing that I've read or heard. Nothing in there that says, nothing in any of the regs so far, or the term sheets provided by the Federal Reserve, talks to any minimum company size, talks to minimum EBITDA. Now, different banks might say they're only willing to entertain these loans for certain types of companies.
Is qualification subject to typical underwriting review for a bank loan of $1 million?
Again, we believe each bank will do these a little bit differently, but the banks don't stand to really lose any money on this, except for perhaps 5% of the balance. So the bigger question of the qualification is how they will credit score you between the 2.5% and 4% range that they have available to them right now.
Is there any specific guidance on what add backs or will or won't be allowed?
Not yet.
So this is basically really attractive growth debt capital, hence the rationale for getting can have nothing to do with COVID-19, correct?
Repeat that question again. Sorry, Hannah.
No worries. So this is basically really attractive growth debt capital, hence the rationale for getting can have nothing to do with the COVID-19.
No, you have to attest that you're getting this as a result of the financial uncertainty created by COVID-19. However, once you make that attestation, as of right now, as long as you agree to keep your payroll intact over the time you have the money, you can use the money for essentially whatever you want, including hopefully growth. That's, I believe, the intent of the program, to use this as a fuel to keep the economy going and growing.
Ami, are you familiar with restrictions on distributions to owners? I've seen that no distributions will be allowed until 12 months after the loan has been repaid.
There will be some restrictions, and we are busy collecting further clarification on those restrictions now, and we'll have it available shortly. But I can't tell you, I don't believe it'll be no distributions. I think it will be no excess distributions vis-a-vis what you did last year or the years before, but clarification will come through.
If you're in the real estate development business, along with being a contractor, can you use the money for deposit on land that you want to develop and approve?
Again, as of right now, as long as you have the EBITDA to back it up last year, you can technically use the money for whatever you want. But some further guidance could come out on that will create more stipulations.
For the uninitiated, are these better terms than typical or previous debt financing? For example, is this worth taking advantage of because of favorable terms?
Yes, if you have plans to work what you think you could do with the money. And again, cash is 9/10 of the law right now. If you have no plans with what to do with the money, or you can't conceive of a use for it, then it's not worth it.
Is a note payable to a prior owner stock buyout considered existing debt?
Subject to further clarification, I would think it is, especially if it's a promissory note.
What if with debt, the final loan about is less than 1 million?
You're not qualified.
Will there be any
Quick
forgiveness?
note, I'm sorry, quick note to the folks who are posting, only 2 of you who are posting in the chat. We're not going to be able to answer questions from the chat. So if you have questions, please post them for us in the Q&A. Thanks. Go ahead, Hannah, sorry.
Will there be any forgiveness for that Main Street program?
No, this is debt and you're responsible to pay it back, but there are no personal guarantees against it.
Are there any legal entity restrictions? For example, can an S corp qualify?
At this point, there are no legal entity restrictions that we're aware of.
Can funds go to a new LLC that rolls into a parent company?
I would think so, but that will be subject to further guidance.
For the MSP, why did the provisions restrict compensation and capital distributions 12 months after the Main Street program is paid off? Do you think that will change?
I think they don't want the users of this program to take the money and put it in their own accounts. That's the idea. That's not the idea. The idea is to grow the economy, not take this as personal distribution.
Clarification on when they will be able to apply for this loan?
Yeah, that's subject to it all becoming available, but we believe this program should start opening up middle of May.
As for liability calculations, we hold substantial deposits, which are liability but not debt. Will this be able to be removed from the liability calculation?
Again, subject to further guidance, I think that will be the case.
Will a holding company be able to borrow based on the compiled financials of its subsidiaries?
We believe that's absolutely the case. In fact, that might come down to it that the subsidiary can't do it. It has to be at the holding company.
All right, looks like the rest are PPP questions. Can I start with
Sure.
those?
Happy to take a few PPP questions, no problem at all.
Okay. Regarding payroll forgiveness, will payroll paid to an owner be forgiven? If so, will it be forgiven if paid to an owner as a distribution versus payroll?
It's not 100% clear. The forgiveness, I know it's frustrating to people, but the guidance is not clear on the forgiveness. So my answer is I think so, but that'll be subject to further guidance and subject to how each individual bank chooses to interpret it.
We're in the restaurant business, so we could include the tips on payroll for the forgiveness, correct? We had some profit sharing, and could we include that in the forgiveness of the loan as well?
Again, I know there are a lot of understandable questions about what will be forgiven, and I understand why. Tips are clear, profit sharing is not clear. So we're all waiting anxiously for guidance on exactly how the forgiveness will be determined and calculated.
Cabbage is taking applications for the PPP. Would you consider them safe to apply with?
Yes. However, I'll reiterate that I still think instead of going through one of these massive portals, if you can find a local bank or credit union in your community that's taking and processing PPP apps, you have a better chance of getting it done quickly. Guys, we're going to have time for one more question, and then unfortunately, I have to jump on another commitment.
If June 30th comes prior to the 8-week window from the date of the PPP loan, are you still allowed to count 8 weeks, or is it reduced per the June 30th date?
I'm pretty sure it will be 8 weeks.
Perfect. Thank you so much, Ami.
Guys, just to reiterate that, thank you for your time. I know it's tough out there, and if you do want further guidance or help on the Main Street lending program, feel free to reach out to Megan Burns at mburns@multifunding.com. We wish you all well and Godspeed, and we'll be back online next Tuesday with another webinar if anyone wants any updates. Take care now. Bye-bye.